Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, copper, and Bitcoin. Today, I have a fantastic show for you. I have got Randy Woodward. He is at The Bond Geek on Twitter, and we're going to talk about what we should be worried about potentially in the bond market and what kinds of things the media is saying versus what's really happening on the ground. I'm super excited for this interview. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading those CME Group event contracts. That's what we're using at Place Your Trades. So let me just start off by showing you the Place Your Trades website here. This is, once you've created an account and logged in, this is pretty much what you see here. You can go to the live streams. We have live streams every single day. Or you can go to this pre-market. Guess who writes this pre-market? Chai freaking Girl. Chai Girl writes this pre-market for you. So you can just come on every day and just see what's going on without having to look everywhere, without having to watch the networks if you don't want to, and just get a bird's eye view of what's going on. To start your day. And then one thing I like to do every day is I like to look at these gap statistics. We have them for metals, we have them for energy. I think they're especially valuable for the indices. So that's what I really pay attention to. And what I'm looking for here is anything that's 55% or above, and then a profit factor of 1.3 or above. So you can see NASDAQ looks pretty good. What this means is that it has a 55.6% chance of closing above where it opens for the day. So, does it, in other words, buy the dip? Question mark. Okay. So that's what I look at every day. And then just to give you just an overall view of the market, though, and what's happening right now, today is the last day of a month. And one of the things that I like to do is I like to stalk Anthony Crudele's account just a little bit, because he's one of these that he looks at the first day of the month and the last day of the month, and he's been pretty freaking accurate on what happens. But anyway, as far as event contracts go, this is basically what the app looks like on your phone. And one thing that I like to do, though, is especially at the end of the month or at the end of the week, options, whatever is for the event contracts. Usually, if I decide that I'm playing them that day, I will wait until pretty much the last 10 minutes of the day, and then I'll go from there, because, and I was just telling my group, I have a sneaking suspicion that today might just chop around in sort of a pennant formation on the hourly or NQ, for example, and then make a decision at the end of the day. So I don't really want to waste my brain power, my time, and I'll just wait until the end of the day, and I'll see whether or not something looks appealing to me. And the way it works is you could spend from a quarter up to $20, and you're basically saying, will it close above this amount? Yes or no. So, if, for example, at the end of the day, you wanted to say yes to the 4620s, that should be cheaper than $10 because you've got the 50-50 chance at $10. And then you make more than double if it did that, right? So that's what my plan is. I'm going to wait to take this trade. And, I guess that's what we're supposed to do, right? Patience. But anyway, speaking of not having patience, I want to talk to Randy. Hi, Randy. How you doing? Can I hear? I want to make sure I can hear you. I think you might be muted. I can't hear you. Can you unmute? This is part of live.
There we go. You should hear me now.
There we go. So first of all, I wanted to talk about what you do for a living. Can you explain to me what is it? A fixed income
broker.
What is, and that's for Raymond James, by the way. I just want to give them credit. But what does that mean? Who are you talking to every day? What does that mean?
Okay, so try to keep it real simple. And I guess I should say first, what I do and what we do is very opaque because there's not many of us who do it. We're measured in the thousands, and that's it. essentially, when a bank takes in your deposits, it has, let's just keep it simple, three things it needs to do with that money. It needs to primarily lend it out, which is the economy, right? That's what runs our economy. It is any extra funds, which is something we'll talk about, will be invested. And then they will also have to pay expenses and salaries and whatnot. So the extra funds that they don't lend out, that has to get invested in bonds, very safe bonds, by the way, for most banks. That's what I do. So a bank will come to me and say, "Hey, I've got X amount of money to invest. Um, what should we do with it?" And so I help them find the right bonds and get that money invested and to hopefully keep it very, very safe.
Do
That's
you work
really,
mostly with the regional banks, the smaller banks, the ones that
yeah,
are?
I'm mostly, okay, so that's a good question. So most of my banks are, let's say, 500 million to, I got a couple over 10 billion. The grand scheme of things, that's actually still pretty small, but that's regional. That's community banking. Okay. So I got clients anywhere from Maine to California and a lot of states in between. Um, and the reason why that was a good question is because the biggest problem I see uh, in both financial media and Twitter, and and I think you and I discussed this before, that I probably on Twitter talk to a pretty high level because my FinTwit crowd is on a high level, right?
Yes, they
Right. It's
are.
it's above a lot of people's head. So for the
Yeah.
people that don't know the intricacies of what we do in banking and whatnot, um, the biggest mistake I see is to think that JP Morgan's a bank. They're not. Okay. They're a massive conglomeration of all sorts of businesses that have nothing to do with community banking. So even when you see, so when when people refer to how much Jamie Dimon makes, for example, who's probably the most famous banker, everybody knows that name. Well, that has nothing to do with reality for most bankers. 99.9% of bankers are not making what Jamie Dimon makes.
No,
Jamie
no.
Dimon is a celebrity. And as a matter of fact, and we maybe get into this, but I've had time with Jamie Dimon when I worked for Bloomberg in 88 to 95. I covered all of Wall Street, and Jamie was one of them. And he was not a CEO at the time. He was, running a fixed income floor. But these companies now, those CEOs positions have become celebrity status. So point being is I would say ignore what you hear about those giant conglomerates. Yeah, they're super interesting for financial media, but when it comes out that, oh, their earnings increased here, they're, this, they did this and they made this much money, that isn't community banking. That's not what runs our country. What runs our country are the banks that you drive by every day when you're driving around your town. So that's who I'm taking care of, or the day-to-day, community banks. And that's why I got interested in doing these podcasts, because of what I heard about, you know, Silicon Valley and Signature and First Republic, and oh, they failed for this reason, that reason. It's, you know, most of that was not true. And
Really? So,
yeah,
so uh, how? I mean, so just from somebody who occasionally hears, I try not to listen to the financial networks in general because I feel like it's just not the information that I need in order to be successful.
it's not.
But it's not. But what I'm seeing a lot of people say on Twitter is that, some people are saying the banking situation is completely behind us. It's done.
That's
We've
bullshit.
moved on.
Yeah, that's ridiculous.
Okay. And then you hear the Fed speak talk, and I mean, I almost did a drinking game of every time one of them says that the banking sector is resilient and blah, 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 I'd be a drunkard, right? But it seems like it's gotten the drama, it's gotten its 15 minutes of fame, and now it seems like more banks are failing, but at a slower pace, or maybe it's one here and there. But like, what do you think is going on? And then I guess the question is, and from what you said before, I want to know why.
Right. Okay. So the first thing you said is, that financial institutions are strong. That's what you're hearing from the Fed. It's what you're hearing from Yellen. Can they say anything else? I mean, they can't.
That's
There's
true.
really nothing. They have to say that as a fact, they have to say that because they can't cause stress. They can't cause panic. And I promise you, those 3, 4 banks that went under, they had no idea that was coming. They did not see that to save their lives. And
Wow.
they were in absolute, panic mode themselves, trying to figure out, especially that weekend after Silicon Valley. I mean, it was a total, free for all for those guys. I'm sure they worked all weekend. And in reality, if Silicon Valley Bank had access, these are sophisticated things too, but to this BTFP program, the Bank Term Funding Program, which basically the Fed, that's the other thing I guess people should understand. That is one of the most incredible lending facilities ever known to man. And the terms of it are absolutely unheard of in anything I've ever read. So it was an absolute bailout for banks going under deposit stress, a run on the bank. Had that facility been around for Silicon Valley, they'd still be here. They wouldn't have failed.
Wow.
So I guess that's the first thing is you got to really ignore anything the Fed is saying, and look at more of what they're missing. That's probably the thing. I mean, you really ought to, the thing, everybody, for your, more just modern day, people not in this, in my world.
Yeah, I don't think most people, I mean, when I looked at your Twitter, it's sophisticated. And I think it's important that most people understand generally what's going on, especially from somebody like you who is on the ground. But whether or not we need to understand the mechanics behind all of the different charts, I don't think so. I don't.
Well, sometimes sometimes you do.
Sometimes,
and you should ask. If you see something, people like me, and there's like my FinTwit crowd, the people I follow are fantastic. And if you just ask questions, if you just simply say, "Hey, could you add some verbiage here? I don't really understand what this is saying." You're going to learn. And let me just tell you something. I've been doing this since, like I said, 1988. I got my master's when I started working for Bloomberg, and even there, a lot of people probably don't know what Bloomberg is. And let me say what that is real quick. So, particularly in fixed income, in bonds, you got stocks and you got bonds. Particularly in bonds, Mike Bloomberg basically created a system to analyze bonds. It didn't exist, and nor did the computing capacity exist at the time. So as he got into the 80s, computing power got powerful and more powerful. And so what my entire industry, we all communicate, we all use Bloomberg for the most part. Now there's some other systems, but it is the number one thing on the planet used for fixed income, for bonds. And it's becoming so that way for equities as well. So it's about 25,000 a year. It's a very expensive machine to have. But what it gave me getting into industry was I got unfettered access to Wall Street. I got to go in and out of Wall Street trading firms. When you see the Big Short and when those kids go into the trading floor at Lehman and there's nobody there. Well, I've been on that floor, that exact floor I've been on. Mm-hmm. And I've been on those floors for all those Wall Street firms. So I got to see a lot of interesting things. I got an inside education. Where I'm going with this is that, if you really manage your Twitter account really well, there are so many amazing people to follow that you're sitting next to them on those trading floors. It's the same damn thing. And they'll talk about things they're doing, things that they're reading, articles they found interesting. That's where you got to go in and you got to read. You got to read and find books, and that's how you get educated. And as you do that, then you develop the ability to listen to financial media. Well, like you said, I've stopped listening to financial media because a long time ago, because the more educated I got, the more I realized they have no idea what they're talking about.
Exactly. And it made me question myself. And I just, because somebody would come on that sounded very confident, and they would,
yes, they always do.
They always sound so confident, and they're always, they seems like they're 95% of the time wrong.
Yeah.
And I thought to myself, how do you make a living doing that? And then I realized it's their job to sort of mislead people like me who are listening and that will do what they said so that they can exit or can,
Well, I don't
you
want
never
to say
know.
it's that sinister. I mean,
No,
that
no.
does go on. There are people who talk their books on these stations, and they go on purposely to do that.
Sometimes
So that's why I think, for the most part, they're to be ignored. I mean,
you
I'm
never know.
constantly, every other week, I'm getting a call from my mom about somebody said something on CNBC, and I'm just like,
Yeah.
could you please turn that off? There's got to be something else you could watch. Go back to the Weather Channel. I'd rather you spend time there.
You realize they're going to ask you to be a guest right after this. You realize that,
Yeah,
right?
probably.
Probably.
No, I doubt it.
Now,
But so I think ultimately for most people, what you have to understand is that the Fed is trying to control markets. End of story. Okay. That didn't necessarily wasn't always the case under other Fed chairmen. So you got Volcker and you got Greenspan. You should read books on these guys, know who they are. These are the most powerful people on the planet, probably more so than most politicians. Um, the one that got things really going in a different direction was Ben Bernanke. He decided that we need way more control over markets because, that's the benevolence of our efforts, is to keep mankind safer. So we're going to control markets, which means they're not markets anymore. Right. So it's, you know, so that's, I guess the first thing I would do is tell people to start, reading about what is the Fed? Who are they? What do they do? And that you just be more educated that way. And you'll probably, your bullshit detector will be much, much better. You'll be able to go, okay, what that guy just said is not true.
so I want to talk about the banks, though. I want to talk
Yeah.
about why you believe they actually failed, and then I want to talk about something else, which is a really weird thing. I was saying this morning to my group because RTY has been doing really well lately, and it's got a lot of regional banks in it. And I thought to myself, in the tech market, a lot of times you want to own the companies that might get acquired by somebody else because then they'll be worth more. So is it sort of the kind of thing that now you almost want to own some of the regional banks because you believe they'll get acquired and therefore the stock price will go? Maybe that's such a basic question,
Yeah.
but I was thinking, is that a thing now? Could it be a thing where you want to figure out which banks will get acquired and get them right at the right time, and then whoop, the stock price?
Yeah. Well, I mean, I got to be careful because, I am a securities broker,
Oh,
so I
sorry.
can't talk.
Oh,
No, no,
yeah.
no, you're fine. No, 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 no. I'm just going to tell you that I'm not going to talk about individual names or anything like that.
Okay.
And I want to be careful. I'm a bond guy. I'm not a stock guy.
Okay.
And to explain that, and I temper my words in that most bond brokers are or should be pessimists. When we look at bonds, particularly for financial institutions, that money has to come back to you. There isn't any doubt. Okay. So if a community bank is not going to invest money and maybe get their money back, that's never going to happen. Now every once in a while it does occur and it's not good. It's really, really bad. So when I look at bonds for my clients, I'm looking for the bad things first. Okay. That's my first thing. What is really bad about this bond? What's hiding? If I can't find it, then I move on and say, okay, what's good about this bond? Trying to find the best bond. So, keep that in mind. When it comes to bank stress, I think, and this is, again, I always refer to these things, and I got to realize so much of I'm getting old. I'm 56 now. So many people that I'm talking to right now, weren't even in the markets in '08. I mean, I did a podcast and with Joe, and Joe's like, yeah, I was 6 in '08. I'm like, oh God, man, now you're so, but I believe if you've studied it all or you know anything about Bear Stearns, they had 2 subprime funds that failed. And it was early. That was sort of a tip of the iceberg. People should have looked at that and said, there's a problem. That doesn't happen. These banks that just failed, they did not do anything wrong. Their models were fine until they weren't. And then all of a sudden, oh, well, of course. And, it's amazing to me that even bank CEOs, the ones I may deal with or friends that I have that should know, don't know. Like, they trust financial media, and it's so weird to me. So let me give you an example. What really got going with Silicon Valley Bank was that Goldman, by the way, prudently said, hey, look, we see what's coming down. We got this problem with what the Fed has done to our balance sheet. We can talk about that in a minute. We need to make some changes to this portfolio. We're going to go ahead and sell the AFS portfolio, available for sale. Just means it's bonds that they can immediately sell, and there's no restrictions. And we're going to take a loss. Okay, 20 billion. I think they took a $2 billion loss. And that's what, holy shit, I didn't know there was a loss. All these investors are like, what do you mean you're taking losses? What do you mean your bond portfolio is at a loss? Well, that's what caused panic. Now, we have this uninsured depositor thing that, they had 90%, 95% uninsured, which means huge depositors. All of a sudden, rumor is they emailed each other. They knew each other. Boom, boom. Hey, you know what? I'm out. I'm pulling my money out. That's a run on a bank. Okay. We've all seen It's a Wonderful Life when the guys are standing in the street and they go to George, what's going on at your bank? I've never seen one before, but that looks like a run. Okay. In that, turn this off. There's no difference between that happening during the Depression and what just happened on a run on a bank. You can never really explain it. You don't really know what happened. You don't really know why. But once it gets started, no one can defend against it.
Okay.
And no one saw that coming. So the portfolio, everybody immediately blamed it. What I heard on news was, they bought bad bonds. Now, this is financial media saying this, and it's even ex-Fed presidents had said this, which is mind-blowing to me, because it makes me realize that guy doesn't know what a bank portfolio looks like. He may have seen it in passing, but he can't look at it and in 5 seconds say, no, actually, that was a fairly conservative portfolio they sold. Okay, that's the thing that people need to understand. Their portfolio was on the conservative end of the average of the entire United States banks, institutions. Okay. They did not buy bad bonds, but because of what the Fed has done with interest rates, they have a lot of losses. Every single bond owner in the entire world is dealing with the same thing. And so that's what happened with Silicon Valley Bank. It sharing that information cause panic.
Got it.
And once the run starts, listen, it's no different if one of us is driving and we drive past our bank on our way to work or on our way to school, whatever, and we see 200 people lined out the door. Now, unbeknownst to us, you can have a free donut day, but we don't know that. We just see 200 people lined out the door. You're literally going to stop your car. You're going to get on your phone and you're going to move your money to somewhere else. You don't care what the reason is.
Right.
Okay. That's what happened.
Okay.
Then,
yeah. And I feel like maybe they wanted, I think, especially somebody in such a high level, if it is a phenomenon that just happened probably because it's just like a butterfly flapped its wings. And
that's
then
exactly what it was.
Yeah. But they can't say that because then they will look like they don't have control over what's going on.
They want to blame. That's exactly right.
Yeah.
And what they ended up doing by choosing what to blame, and I guarantee you the regulators were involved. They went after, they actually went more so after the uninsured deposit. Well, that's existed. 50% of all deposits in the United States are uninsured. So all of a sudden that's a problem. Now, yes, they had a very large percentage, but that's been around for a long time.
Yeah.
And even if you're a bank and even let's say you have 30% uninsured, well, if you lose 30% overnight, you're done too. So it was a run. It wasn't because of those uninsured deposits. It it and then it started to cascade. Now everybody's looking at, oh, who else? So now you've got, I'm trying to think of who else that took down the uninsured deposit, but that caused PacWest their problems. That's causing Western Alliance their problems. And far as I know, these are all good banks we're talking about.
Yeah.
That's the tricky part here. They're all good banks. And, like somebody to follow, I'll mention like a couple names, like Chris Wallen. He's on, I forget his code on Twitter, but he's one of the few guys who gets banking because this is what he does. And he said this, and I said, that's so correct. Banks just need time. They just need time. I can explain that. I've given you a screen we'll share in a minute, but I think that'll be a really good way for me to tell people what's going on with banking. But in Silicon Valley's case, that was what happened. And and that's what they're trying to do is say, that's why all these banks that you see now is our deposits are solid. They're so afraid of that narrative that you're losing deposits that they're paying up big time to make sure they don't lose deposits, which is creating a whole nother problem in that they're having to pay us 5% to get our money, to keep our money, but so much of their assets are stuck at 2.5%, 3%. So their net interest margins, their profitability is getting tighter and tighter. And that's the story most people don't understand. That's why on the whole, in banking on the whole, just stay away. Just wait. You don't know what else is coming. I don't even know, jokingly, I said, look, we're not even in the first inning. The first pitch hasn't reached the plate yet. I mean, it is so early into this process.
Okay.
Again, I forget when Bear Stearns funds failed. I forget if it was 06, 07, but it was many, 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 many months before subprime finally became a thing. But that was the initial indicator. Banking's struggling right now. Banking is in survival mode.
Yeah.
But they can do it. If given time, and that's, I know what the regulators are also doing. They know that too. And they're doing things to try to tell these banks, hey, take your time, because I think they know they're going to end up lowering rates probably next year. And a lot of this gets alleviated.
Well, that's the question, right? Because we just had another quarter basis point hike, and the market, the stock market is like, oh, yay. That means that the economy is great and we're going to move forward. And I mean, it seems like at some point there's going to be just one little, straw that's going to send the camel down to its knees. And I guess the question is, by looking at the bond market, is there something that we can look for that would give us some advance warning of anything?
Well, that's the inverted curve. Okay. I want to talk about that, but I want to talk about something really quick. What you if you go read the great essays on the Great Depression, that's what Bernanke wrote. And he is considered the preeminent expert on everything that caused the Depression, and also giving him, I guess, like this hubris, self-righteousness that because I wrote that book and I'm the expert, I can prevent it. Okay. And what he said is super, super important for everybody to understand is he said there was two things that needed to be removed from the visual of the country to help prevent a depression. And he said that's soup lines and a crashing stock market. So what does that mean? That means if you're driving to work during the Depression and you go past 200 people in a soup line and you see maybe friends, you might even see family, are you going to go spend recklessly? Are you going to spend money? Are you going to buy a widget that you've wanted for a really long time? Hell no, you're not. What are you going to do? You're going to save. You're going to take that money, you're going to bury it somewhere, you're going to put it in a coffee can, you're going to, and what that does is it exasperates the problem, because what he said is people get irrationally frugal. I think that's exactly how he put it. And that makes it much worse, you know, and this is what Keynes he talked about that. Keynes had a famous radio address. John Maynard Keynes, famous English economist, said, he literally talking to women, go pull that money out of those coffee cans, get that coffee can off the cupboard, spend that money, and we can fix this depression. Okay. So that was what one thing. The other thing he explained, now think, this is the powerful one. He said, if you go somewhere, some rural community in the United States, where there might be 100 people as a population, and go take somebody who owns a store or something like that and say, hey, how's the United States economy doing? They're not going to know. I mean, they got this tiny little town that they live in and they've got their community. How are they going to know? Well, they're going to know by the Dow Jones. They're going to look at the newspaper and say, well, the Dow Jones is up. I guess it's good. Or if they look and they see crash and this and that, they're going to be like, oh my God, it's terrible. Now, their life hasn't changed a bit. They don't own any stocks. Nothing's changed. All the people that still live there. But what they do is they hunker down. They get irrationally frugal, and they make it all worse. All that means to me is the Fed has got to manage the stock market. They cannot allow for crashes. Okay. You read that. It's an important book to read. Then read Bernanke's super hubris book, The Courage to Act, about all his experience of 2008. I promise you're going to read the word markets, equity markets, stock markets, more often by far than you will inflation or unemployment, because he cannot allow the stock market to crash, according to his philosophy, because that makes people, get scared.
Right.
That's why I wanted to point that out.
Got you.
So if you look, I always say on Twitter, throw Powell some limit down days, which means stock market trades so much they have to shut it down when it falls too much. Let's see how he handles that. All this confidence he has and higher for longer and all this, that will be blown to hell in 2 seconds. But he has not had to deal with that. And just like you just said astutely, if 3 of the largest bank failures in the history of the United States, the stock market's like,
I know.
It's cool.
I think we're front running that thing that you said that says the Fed won't let us crash. I think we're even though they're not, so I don't know if they're actively producing money right now. Of course they aren't, right? But I don't know. But we're front running that. We think that they're not going to allow that to happen. There's, volatility is super low for like the fact that we're just
insanely low.
Yeah, we're just going up, and that's it. And I mean,
so you mentioned learning. So follow. This is, I think, one of the coolest guys to follow on Twitter is @prof99. That's PROF.
Okay.
99.
Let me see if I pride myself on finding good.
You might already be following him. Yeah.
I hope so. All right. I'll take a look here.
@prof. I'm just making sure I got it right. No, I'm sorry. @profplum99.
He follows me too.
Yeah, good. PLUM 99.
You know what? I'll make sure I'm paying more attention to him.
Yeah, because this guy's and again, this goes with my, what I'm trying to educate people here on. And look, we can do this as much as you want, because I really, I think all this is really important for a lot of people to hear, again, because there's just so much misunderstanding with financial media. But Mike Green, I don't know where the hell he came from, but he came out, I don't know, it was 4, 5, 6 years ago. He walked off the Serengeti and just started educating people about passive investing. And if you've never heard of that, you need to study it. Go read everything he's written on it. Very simply, it's just basically Vanguard, BlackRock, give them $1 and they just put it into the market, into an index, end of story. No thought goes into where that dollar's going. It's all market weighted. And the bigger that has become, the less I believe, and what Mike believes and preaches, the less reality that's in the stock market, right? Because you have so much indiscriminate buying going on. It's overpowering the people who are supposed to be buying companies of quality, companies that will return money to you. So anyway, that's one of those guys that you got to really pay attention to, because he's a big vol guy too, and he talks a lot about what you just said, that vol is just so compressed right now. It doesn't represent, well, vol's coming sooner or later, and
Yeah, and I mean,
that's when it gets interesting. That's when
it's
things.
I mean, from a futures perspective, when the contracts roll, it is super rare not to fill any kind of gap that comes up in a futures contract roll. And we still have some gaps to be filled way back from just a couple of months ago. And I feel like if there is some kind of drop that's not bought, it's going to be potentially, like you said, maybe a very large one. However, there's so much buying to be done that people are making me doubt that. So
I never really understand that, because it's like, yeah, they're like, oh, cash on the sidelines. Okay, well, if I buy something from, if I take my cash and I buy something from you, what do you have? You got cash. If you take that cash and buy from Sandy, I don't, it doesn't make any sense. It cash always stays cash. That when, again, financial media, people let those kind of implants into your head. Really smart people get on CNBC and they're like, there's so much cash on the sidelines. Well, it's such a dumb statement. Like, it's not going to just vanish.
but
Maybe there's,
I do know.
I just don't get it. I mean, again, I'm not a stock guy though. But
I
and I've been long for a really long time when it comes to stocks, because I just don't get the levitation. But hey, it is
well,
what it is.
I do know people who took out their money a while ago, took it out of the stock market. They liquidated their 401k into cash or whatever, and I remember them telling me in January this year that they were going to put it on, but put it back in. But when we're really, and I thought to myself, wow, you're a better market timer than I am, because like for the most part, I do trade my 401k, but I do stay net long on it because it's so hard. And now I just had the same person that told me that text me about Tesla the other day, and they're like, when can I get into Tesla stock? And I thought, oh no, like they've waited. So, I mean, oh no.
Yeah.
Now their patience is going away. So it's not that there's, cash on the sidelines. It's that they're seeing all the people around them making money that didn't do what they did.
That's right.
And now they're gonna time the top. Like the second they text me and say, it went down.
All in. Yeah.
I went down $2. I'm in. I'm like, oh no.
Well, there's that. That happens. It's actually has happened. People don't realize. First Republic was a very, very, very well-run bank, and I don't know. They started losing deposits. I don't. They failed for a different type of reason. But I know people who knew that bank very, very well, who were tripling, quadrupling down, because they're like, there's no way that bank's going to fail. They're amazing. We've worked with them for all these years, fail. So yeah, it's really, and that's the problem in a Fed manipulated world. It's really hard to see reality, and because they're really trying to hide it from us, and they really are.
So you think this is a little bit of smoke? And I mean, the markets can be manipulated, obviously.
Absolutely, yeah.
So you think there's a little bit of smoke and mirrors going on right now?
There's so much. Listen, man, I learned to see it when I was in all those Wall Street firms back in the late 80s, early 90s, and I saw so many smoke and mirrors by just Wall Street. But then as the years went on, I realized, well, shit, the Fed does it too. The biggest smoke and mirror, and I'm not going to get into details now, but I would implore people to start to pay attention to this, because this story is not over, but is the killing of LIBOR is one of the biggest control mechanisms the central banks have ever taken over, and the smoke and mirrors that they had to use to try to make it look like they had to take it over is unprecedented. It's scary actually too, and that's
Hmm.
going to be a story. And I'll plug my buddy's book. It's not really even a buddy, but you know, LIBOR is something I've studied my entire career, so I've written a lot about it over my life. And this guy connected me. He's a BBC financial journalist, and he connected with me about a year or two ago. He said, "Hey, I'm seeing what you're saying about LIBOR. You need to, we need to talk." And he had been working on a book, and it's called Rigged. Uh, Go get this book. Everybody get this book and start to read it. And what you're gonna, what it's gonna make you realize is like, oh my God, you know, this is they destroyed people's lives to take over, to destroy LIBOR, so they can control that short rate. Talk about that in the future if you want, but point is read that book. You'll see it is manipulation. It's smoke and mirrors just to unprecedented levels. Um, and yeah, that's what's going on, and that's what's going on with banking. Is they're doing the same thing. They don't want to be forced to lower rates again. They want to make sure inflation's coming down, which I believe it is. I believe they've done too much, and I believe they just need to give it time, and it'll
Yeah.
it'll come down. I actually believe we're going to go into deflation. Um,
I know a
but
couple of people who do, and that's a
yeah,
bad, that would be bad, right?
horrible. Yeah, horrible because again, if you read, that's why Bernanke's books are so important to read. He talks about why deflation's so much worse, and that you lose control of that. They the Fed can't make us buy things. If we decide not to buy things for a prolonged period of time, that's deflation. Deflation leads into bankruptcies, leads into high unemployment, can fuel us into a depression. So
Mm.
that is why we have this 2% target, because it's not zero. It's not
Right.
negative. We have to stay away from zero. You know, you know, why can't prices correct down for a little while? Well, because of what it could become. That's why the Fed, all central banks have to manage that, or they think they have to just stay away from that deflationary number.
Okay, let's look at the chart that you showed me before.
Well,
Um,
I changed, and we'll,
oh, good. Okay.
because you mentioned this, so we can go to that one too. But this is, you said, well, what are you seeing with the bond market? Well, this is what an inverted curve is called.
Okay.
Basically, you've got short rates here, which is you got 1 month, 6 month, 2 year, up around, over 5% now, right? So here's
That's what that's TLT, right? That's the
it's
TLT.
treasuries.
Okay, yeah. Okay.
Yeah, this is all just treasuries. Okay. So safest investments in the world right now, because of the Fed's managing the short rates, SOFR and whatnot, they have all these short rates up at 5%. Okay. Well, here's the 10-year, the bottom of the curve at whatever we're at right now, 393. Okay. All right. So let's talk about that. Now, first off, this rarely happens. It only happens when the bond market knows the Fed is going to raise rates. The Fed's raised rates. They're going to cause a recession, and the Fed is going to be forced to cut rates again. Okay. Why would I want to buy a 10-year at 393 when I can buy a 1-year or a 6 month at 545? It's because I know that in 6 months, I'm going to get that money back and the rate's going to be lower. And then in 6 months again, I'm going to get that money back and rates are going to be lower. And eventually, those rates are going to be so low, I would have been better off just buying the 10-year at 393 and holding it for 10 years than buying all these short rates, which eventually go back down to zero.
Okay.
Does that make sense?
Yeah.
So
Yeah.
that's called reinvestment risk. Okay. So and it's tricky right now because, here, all these banks are having to pay over 5% for your deposits on a gradually increasing basis. Yet in my world, my investments are below that. Now, what's that mean for me? It means my business is dead right now because I don't have anything to show them that they can make a spread, that if they pay you 5%, I can show them 6%. Right? I don't. So what are they doing? They're really, if they can't find a better way to invest that money or loan it, then it would be better to shrink. It'd be better to say, you know what? I don't want those deposits. My money comes back from various cash flows, whether it be loans pay off or my bonds mature. I'm going to take that money. I'm going to give it back to the depositors. Doesn't work quite that way, but in theory. And I'm just going to shrink the bank, and because I can't make a spread right now. So what's that mean to you and the economy? It means less credit availability, right? That means they're going to loan less. And that's what's happening right now. And that takes time to hit the economy. And that's why there's this delayed lag to everything the Fed is doing. It's a delayed lag. But that's what this inversion tells you. And every time this curve is inverted, I can do it this way, USYC 2-year. So what I'm showing you here is just 2s to 10. We're going to look at the 2-year yield versus the 10-year. And you can see it's negative, meaning that the 2-year right now is 92 basis points higher than the 10-year. So that's defined as an inverted curve. Okay. And you can see, watch this real quick. All I'm going to do is add. By the way, this is the system that I use called Bloomberg. That, in case somebody doesn't know that.
And all you bigwigs are on that Bloomberg Messenger. That's what you were talking about.
That's exactly
I know.
Right.
I want the Messenger without having to pay the $25K.
I know. It's very powerful, and it's a little bit, a lot of what you see, including it's called IB, Instant Bloomberg, is something I helped promote, help create because I was at Bloomberg. Bloomberg is kind of small when I started in '88. There weren't even 10,000 terminals. Or now you say, applications or whatever, but now there's 350, 375,000 all around the planet. So I was at that a very unique time. I watched all the stuff being built, and I helped build it. So this is zero line. You can see the zero here. Every time this inverted curve goes below zero, or the relationship goes below zero, that means it's inverted. Okay, and look at the red shaded areas I added as recessions. It always inverts. A recession comes and it uninverts. So that's where we're at right now. And we're at a fairly severe level of inversion, which means conviction. That means the bond market is more convicted than it's been since the Volcker years. Think about that. Since the 70s and early 80s, that's how convicted the bond market is.
What if they're wrong? What if they're wrong? Then what?
They're not going to be.
Okay.
They're not going to be.
I don't know.
I'm a bond guy, but they've never been wrong before. So I don't know what wrong looks like.
Well,
I'll tell you what wrong looks like. Here's what wrong looks like. Wrong looks like the Fed panics. They start QE again. The government panics. They start stimulus again, which then increases the level of M2, and everything is saved. And now we have a whole bunch more money, which is a false way to save things. But that's the only way the bond market would be wrong. And the bond market would actually be wrong. The inevitable would be delayed. That's why,
So that's my question. So let's say, for example, we get a correction here and we start to go down, and, we don't reach the lows that we were in earlier in January, but somewhere around 30, whatever. Let's say we start to go down, and then they see what could potentially happen. They want to do the smoke and mirrors, election year coming up. So then they turn on the printers again just to get over that, November election hump. Then what? Like, nobody ever wants to be in charge when the printers are turned off. Well,
that's the other thing too. I mean, do you want to be a Fed chairman that we hit a depression or we hit a massive stock market crash while you were in charge?
Exactly. No. Nobody wants that. So
I asked a bunch of economists. I said, I showed him M2, M2, just money supply is falling. I mean, if anybody studies economics at all, you look at Irving
I saw.
Fisher and I can't forget our most famous guy, but look, if M2 is increasing, you're going to have inflation. If M2, the supply of money is coming down, you're going to have deflation. End of story. And now there's a lag to that, but M2 has come down and it blipped up last I forget quarter, but it's been down consistently for a couple of years now. To me, it's inevitable. It's just there's a lag to all this. So I love when people say the bond market's wrong, and they were like, no, the bond market is not wrong. They're anticipating what is coming. They're not timing it. There's no way to time it, right?
Right.
But when you look at that inverted curve and you see, basically, I think what I showed you, let's see. Somewhere right around, let's see, right now, the 1 year, you got the 6 month is the apex. It's the highest point, starts to come down a little lower in 1 year, and then really down in 2 years. What that's saying is in the next 6 to 12 months, I think we'll see some reality.
So your view is that we are headed for a recession.
Yeah. And by the way, that's okay. I mean,
and not a soft.
You're supposed to have recessions. I mean,
right. I know it's weird. It's
creative destruction. I mean, I don't know which economist said that, but that's a genius. That is what it is. Not all companies are good.
Right. Yeah.
Not all ideas are good.
Right.
Things need to fail, and that's okay.
So is it going to be, is there such a thing as a soft recession? I don't know, but is it going to be a very hard fall and then we stay at one place for a long time, or are we going to come down and then go back up, slowly? I remember the .com crash, and it took freaking ever to make back all that money that was lost. So the question is if there is an AI bubble, and if that bubble pops, is it going to be something where we stay down for a while, or is there any way that we can, I guess your personal opinion, would be interesting, but also it
depends on your age. Let's keep it really simple. You said that it took forever for it to come back, right? Well, if you're 25, 30, cool. It came back. You said something you got to be careful with. You said all that money lost. Well, not if you didn't sell.
That's
right. That's always an important. I always try to I point that out to people. Hey, and that's the same with the banks that we've been talking about. They have unrealized losses. They don't have any losses in reality unless they're forced to sell. Then it's a loss.
Right.
It's the same for you and I. If we have if we see a stock market crash, okay, do I need that money right now? No. Can I wait? Yeah. It'll come back. So I don't know, but if you are, 75 years old and you think, if you look at all the money that you have and you say, look, I'm going to go all into fixed income and cash flow, I'm out of the stock market, probably no matter where the stock market is, that'd be a good idea. If you're relying on it to go higher, that's pretty scary, I think. So it depends on your age, so to answer your question, I don't know. I don't, there's so many manipulations. And remember, when Powell first took over, if you guys remember, oh God, hold on, postpone that. He came in all guns a-blazing because Yellen had started raising rates. He go, oh, set path. I'm going to keep on raising rates. No, not going to change anything. He came in with this bravado of, hey, I'm going to let markets be markets, because that was his history. He's not an economist, And all of a sudden, we started getting some limit down days. He paused. We got some more limit down days, and he started cutting rates, right? So they can go back and say, oh, there was this, there was that. That's ridiculous. No, it was the stock market made them do it. End of story. This time, I don't know. Will they do it again? Can the stock market sell off that aggressively again, see some limit down days? I don't know. If it did, will the Fed act? Hell yeah, they will. Will it matter? I don't know. But the fact of the matter is these things, can happen, and they will cause the Fed to act,
Okay.
just like they did with this, everybody. I'm sure most of you don't know what the BTFP program is, this incredible lending facility that basically it just said, hey, very simple. It said, banks, if you're losing deposits, bring your collateral to us. We will give you the money until you can get things stabilized. And we're going to give you money cheaper than anywhere else you can get it. And we're going to give it to you on terms that no one will ever in the history of man give you terms like this, which, basically is just, here's your money, here's your rate. If the rate's lower tomorrow, boom, that's your rate. If it's lower again, boom, that's your rate. Nobody lends money that way. But the Fed did, and the Fed has. That's panic. I mean, that is a holy crap. Things are going, we got to do something. And that's what they came up with. So, yeah, so that's where we're at.
Okay.
I want to show you one thing because I don't know how long you usually do these things, but they seem to be about an hour.
Yeah, we can do whatever until we're not saying good stuff anymore. So what's going
I'm not
on?
saying anything good. I don't know.
No, well, you know what?
That was 5 minutes in for me anyway.
No, it's what we need to know, right?
Yeah.
So what is this chart here?
Okay, so this is the number one thing everybody needs to realize in the whole world, and I try to explain to anybody that I meet. It's the 5-year yield, Treasury 5-year yield. Very simple. 5-year yield is 170 going into the end of 2019. We hit COVID. Okay. First off, that already is a Fed manipulated rate by them buying bonds and buying treasuries and QE and all that. It's already too low. But think about this. We hit COVID, and the Fed has to now really, really act to prevent catastrophe, economic disaster. They take rates down to essentially zero. Okay. So like right there, actually the bottom was, you can see August 4th, 2020, it was 0.19%. Okay. Right now it's a 416 right now. That's how much has changed. They kept rates low for essentially 2 years. Okay. Now, what that means is important. If I'm a bank and I got all these loans out there in mortgages and commercial real estate and what's everybody going to do? They're going to refinance. So for 2 years, virtually all the assets I have are refinancing at these lowest rates in the history of man. Okay.
I remember people talking about negative interest rates at that time.
There was,
people were
around the world and that's another topic, but there was trillions of negative debt all around the world. Now that's for different reasons in the EU and whatnot, and the ECB forcing it. But for us, we didn't have to deal with negative rates, but we had to deal with single digit rates. Right. So all this money is now my deposits are at zero. Right. So I've got to make some spread. So, I'm not going to buy a 5-year treasury at 20 basis points. That's not nearly enough. Net interest margin, 20 they want more like 2%, 3%, 4%. That's the spread they need to be able to stay in business. So what do they get? But all my assets are repricing super low. They had to reinvest the money. And so all of you on here, how many of you if anybody had a loan, I'm pretty sure everybody listening refinanced their mortgage loans or any debt that they had for that matter, if they could. Right. And that includes commercial real estate. On top of all that, how many people said, God, man, rates are so low. You know what? I'm going to grab a couple Airbnbs. I can qualify because my payments are so low. I'm going to buy 2 or 3 Airbnbs. Or I'm a company going, geez, I'm making X profit. I can make 10X if I just borrow the money and increase my business tenfold. And I'm borrowing that money at the lowest rates in history, right? So that's what a bank was dealing with then. They didn't buy bad bonds. They didn't make bad loans. I mean, they really did a good job. There's always going to be bad loans, bad bonds. But I'm telling you, with all my clients and everything I'd seen, mostly they're buying terrific, solid, AAA bonds. Well, then all of a sudden, And by the way, during this whole time, how many times did Bernanke say inflation's transitory, lower for longer? These are all things he said. So what is a bank to do? You can't, there's nothing you can do. And by the way, when you're down here, this whole hedging nonsense, oh, they should have hedged. Well, that's ridiculous. When rates are this low, the only thing, okay, hedge against rising rates. Well, the person you're hedging with is assuming rates. That's the only disaster here is rates go, so you're going to pay a fortune for that hedge because, we'll get killed if rates go up a whole bunch. So we got to charge you for this whole hedging thing's nonsense too.
Okay.
It's not a panacea. Anyway, now the Fed ramps up rates, the 5-year follows, and you got rates go up, 400 or 500 basis points. There's your problem. Okay. All the assets I had on my book that I was able to keep in 20 and 21. Okay. Let's mortgages that, mortgage pools that weren't paying off real fast, bullet bonds that, like, let's say I happened to buy a 10-year, 2 years before this. That's not coming back to me. So guess what? And this is just bond math. If I own an instrument that's yielding 3% and rates go to 0.19, I have a massive gain. Okay, because if I want to sell that, if you want to buy my bond and I got a 3% coupon, and I can replace that with a 0.2% coupon, you're going to have to pay me a lot of money to get that bond. So you're going to have to pay me the amount of money over how I own it, so it equals current day markets of 0.2%. That means I have what? Massive unrealized gains.
Okay.
Do you understand that?
Yep.
Did I buy good bonds? Okay. Did I buy a good bond? No. I bought a bond and rates happened to go down a whole bunch, making it have a big profit. But if I were to sell it and take that gain, I'm just stealing from future years. That's what a bond is. I've got all that good income coming. All I'm doing is just robbing from future years to bring it forward. So I didn't buy a bad bond. I didn't buy a good bond. So if these guys on TV saying, oh, they bought bad bonds. Okay, let's go back to 2020. The same damn bonds are at massive gains. Are you telling me I bought good bonds and then now you're telling me I bought bad bonds?
No, they're just making an excuse.
They're making an excuse. That's when anybody says they bought bad bonds, just say, okay, ignore him forever.
Yeah.
Okay. Because that is a dumb person that should not be allowed to talk about this stuff.
Well, on that note, Randy, I think this has been a fascinating conversation. I have learned so much, and I think I know a little bit more about, sort of what to pay attention to now. So I really appreciate your time. That was wonderful. Thank you so much. All right, everybody. Thank you so much for listening. I am at Cordova Trades on Twitter. Randy Woodward is at The Bond Freak. And also please follow at Place Your Trade. Thank you, everybody. Have a great trading week. Okay, bye.
Thank you.